Well, I hope this whole class won't be torture for you.
Good thing I'm in a tribal college. Yeah, I had some attitude in it.
Yeah. Okay, let's see. I am going to. Do you have a webcam attached to that computer?
No.
No. Here.
Oh, I got my laptop. I can do it.
I'll give you one.
Oh,
Oh,
I'll be on it.
we do have webcam. You should probably just be able to plug that right in the front. There's only one person here. The plug-in should be
Oh,
in front of the computer.
Yeah. So is it in the email then? Zoom?
It's in Canvas. So if you go to, it's right at the top of the Canvas page. Hey, Carolee, can you hear us?
Yeah, I can hear you.
Yes, but we can't hear you. Oh, just one second. Let me fix this. Okay, can you say something now?
Can you hear me now?
Yes, I can. Thank you. They always seem to like to mute this mic or the audio here, so I always have to like fiddle around with it in a class. Never fun. Never fun.
Is that Candace there in class?
Hey!
Hey!
Trying to set it up though. Okay.
Steve, yeah, my mom is a student. I'm sorry. Thought I was bad.
Are you going to join our class too, Patricia?
No.
Oh, come on.
Hey!
I know.
Love it. Birthday.
Hey, nice job.
Love you. It wasn't yours. See you guys.
Love you.
See
Thank
you,
you.
Patricia.
Mom, these are so super cute.
You're welcome.
Oh, thank you.
All right. Let me get organized. Man, it's so nice out there today.
Yesterday was nicer.
Yeah, it was hotter. I don't know, actually. Maybe today is hot. It got up to 83 or something.
Yesterday.
Yeah,
Today at 72.
I'll take that. Makes me not want to be in, or makes me want to be in Hawaii less when I come back to this weather. Oh, I better log into Canvas too. If everybody wants to log into Canvas, we're going to be in there a good amount tonight.
This is not taking me to a Zoom.
Let's see.
Which one should I do?
It should, so if you go up to one of those windows and just click on that little arrow.
Oh, okay, cool. Thank you. I closed that earlier. Or what is it? Minimize it.
did anyone? I had one student who's here with me tonight express some lack of happiness with the assignment over this last week. Did anybody else experience a lack of happiness?
I just thought it was a challenge.
The challenge? Oh, okay. What? You're going to be challenged probably in this class. Learn to enjoy the challenge.
I will.
All right, I have to take a 2-minute to go grab something out of my office real quick, so I'll be right back.
Not one to go. Meanwhile, how's it going, everyone? I'm in class, checking it out from SAC2. I'm by the bookstore. I had to connect my the webcam, and I do not know where the speaker thing is.
Your webcam isn't showing on our screen.
It isn't,
No, it's not.
but you can hear me?
Yeah, I can hear you just fine. I just can't see you.
Okay, let me find me. Can
I can see you on the webcam.
you?
Yeah, I think if you scroll along, you can flip through who the other students that are logged in.
Oh, yeah. Okay.
I see you though.
Do you see his printer?
Yep.
Oh, yeah. Okay. So I wonder, can you hear me on my mic or his? I wonder.
Not sure. You're pretty clear.
Cool. Stop video, stop audio. No idea. Andrea, how are those babies? Good.
Where's Steve at?
What?
Where's Steve at?
He just stepped away to get some stuff.
Oh, okay.
So I'm instructing.
Oh, okay.
Wow. How about those Mariners, huh?
Are you going to dismiss us early, Candy, then?
No way, that means I'd have to do your homework. Not gonna happen.
Pretty sure that'd be okay with all of us.
No. Marcus, you wanna do the homework?
We got homework?
No. Did we?
Yeah.
Yeah, and some of those questions I was thinking about, you know, the tribal governance and our tribal perspective and how we can relate to some of those. I was like, oh my gosh, if we would only make these sound decisions, informed decisions when it comes time. Okay, he's back.
Yeah,
Okay, pretend you're reading.
quit talking about me.
Pretend you're reading.
Sorry, I had to grab my water. I would have been parched and sounded like
It's
crap.
warm in here.
It is. Let's open the window. All right. Let me get ready here. Okay. I think I got everybody who's here. All righty. So sorry about that delay. So did anybody have any questions about the homework from last week, the assignments from last week? I hate calling it homework. Basically questions, and it is. You have to do it at, well, home or work or wherever you're going to do it. So any questions about any of those, anything out of chapter 1 or the business scenario exercise? No.
I had a couple. I'm trying to find where it was in the assignment. Trying to pull it up. No, that's not it. All right, it might take me a sec.
Okay, well, you can also email me questions if you have them throughout the week or after you've submitted it even. And if you haven't submitted it and today, still submit it. You still get credit. Again, there's a little penalty for having a late assignment, but it's not enough that you shouldn't turn it in. You should really turn it in either way, so even if it's late. So.
Well, there were two parts to the assignment, one from the book
and
then the business exercise.
Right, the business scenario exercise, yep. So, and hopefully, I like Canvas because I can put everything like in a week by week snapshot. So hopefully that helps folks know what we're doing this week and know what's due next week. And as we go through the quarter, right now you can probably only see through week number 3, because as I go through the quarter, I'll add or change information and I'll open it up before class. So that's what I did
So
today.
what are these other things that were from like March 22nd? Are those things that we can expect for our class?
Where are you seeing those?
Under the to-do. Do you guys have that too on your Canvas?
Yeah,
Maybe I shouldn't be telling him.
no, it could be the previous quarter's work,
I
but
know, that's what I was thinking. Is that something we can expect?
possibly, yeah. I don't. So you're seeing March
Let's
22nd.
make sure to save those.
Oh, those extra credits. So you're actually seeing those, eh? Thanks for letting me know.
Carly, save those.
See, I'm still getting used to using this whole thing. So.
Dang it. Sorry, guys.
See, I need help too. You guys are helping me out. I appreciate that. No, I don't have the same assignments every quarter too, and I definitely, as we're getting into the things that we calculate, I change those up, and certainly the tests too. So
No
just
fun.
an FYI. Yeah. Well, I want you to show me what you can do. You know, impress me.
Not like we're gonna know unless you post them.
Well, you'll impress me after I post the new ones. Okay, so we're on week 3 right now at Canvas, and so what we're going to do tonight is basically chapter 2. I'm going to go over the parts of chapter 2 that I want you to know about, and we're also going to register for an NNI Native Nations Institute course that we provide with this class. Called the Nation-Owned Enterprises course. It's an online course that you register for, and you probably are familiar with NNI already, I would hope, through some of your other classes. But it's an institute at the University of Arizona, and they have a lot of great content and videos and things like that in these courses that they offer. And so the college actually pays the University of Arizona every year a fee to be able to use these courses, so you can then use them. And this is a part of their economic development short course, which has 3 modules in it. Introduction to Native Nation Building, which hopefully many of you have taken. Citizen Entrepreneurship is the second course, and then this is the third course, Nation-Owned Enterprises. And we just got I just received the sign-up web address this week, and it's actually listed under week 3 there. And so about halfway through, actually, no, let's do it right now. What we're going to do is I'm going to have you all register in class, because sometimes there's some technical difficulties, and I want to make sure everybody gets to a point where they can access it, or if they don't, then I have the information that I can send to NNI to get you registered. So so here's a a big if. If you've already registered for an NNI course in one of your other classes, this link is going to take you to a page that, so under week 3, it's called, sorry, I just lost my page. Yeah, it's called NNI, Nation-Owned Enterprises Registration. And if you click on that link, it should take you to a page that says Course Rebuilding Native Nations Course Registration. If you've already taken a course, an NNI course, do not create a new username. Just click on that Are You a Returning Student button. And then provide it, I think you then provide it your previous information, your username and password. Yeah, so, but if you haven't ever taken an NNI course, then you do need to create the username and password. So what I'd like everybody to do is just to go through this process, and you should get to a point where it says you are registered, or since I've already done it, I don't get to see what it says. But just let me know how far you get or if you experience problems, because then what I'll do tomorrow, for those of you who can't get registered, is to get in touch with NNI and let them know which users need some technical assistance, and they'll move you along to where you need to be. So if you could all try to do that, and then just let me know. You can either let me know via voice, or you can type me a chat to let me know how far you got in that process. Because for next week, then one of the assignments is going to be for you to work through the first section of the Nation-Owned Enterprises course.
Did anyone else sign up already?
I think that's no.
So as we're going through, do we just, as a position, do we just put student in Northwest Indian College?
Yeah.
I've never signed up for, okay.
Yep, that's fine. Yeah, if you're signing up for the first time, most of the information is so they ask you for the mailing address, because once you've completed this course, they'll send you a nice little certificate of completion. So you can provide your real email address if you want, or not, if you prefer. And then for the email, just give them your student email address here. And I don't know why they ask for a phone, but they've never called me.
So how did we hear about this? Doesn't say. Other
Yeah, you could say heard about it through teacher, school.
Okay. So if I printed that, would it print over that?
I'm not sure. What does it say for your printer when you say print?
Testing my connection speed right now. Says LU13 print 201.
That should be this one, I think. Yeah.
So it says course economic development online pre-K.
Yeah.
Enroll. Yeah.
Yep. Registration confirmed, blah, blah, blah. Thank you very much. So, click there. Let's see where it takes you.
Let me print it first. I don't remember.
So, okay, so it's taking you at the beginning, so we need to advance. So that you're good.
Okay.
This right there. So it may, depending on what courses you've taken before, you may get to the point where it prompts you to enroll in Intro to Native Nations Building. Just let me know if that's the case. And what they'll do is to advance you to the Native Owned Enterprises course, which is where we want you to be. So if you've gotten to the point where it says enroll, just let me know if it's telling you to enroll in Native Owned Enterprises or Intro to Native Nation Building or something else like that.
Hey, Steve.
Yes.
So I hit enroll and now I come up with a screen that says internal server error. User is already enrolled on a course.
Oh.
And I've never enrolled in one of these courses before.
Oh. And so this is the first time you've set up an account, right?
Yeah.
Was your username something like C Toby?
No.
No? Okay. I'm just wondering if there was because we had someone else with the same initials as you who came through the program, Carlene. And so I was just curious if maybe you were having a username issue.
Well, I wonder if I use the same username as she used.
Yeah. So
I wonder if I should log out and try to log in with my user and see if it'll. I got all the way through to where you hit the enroll button and then this screen came up.
Okay.
So it let me set up my own user profile.
Oh, it did. So what was the username that you set it up under?
Cartoby, C-A-R.
Okay. So let me just, I'll just send them an email. I'm going to have to email them probably for several of you anyway. So I'll just email them your username and ask them to advance you to to where you need to be. So I think you're good to go.
Okay.
If for some reason they need you, if there's already a user with that name, I'll let you know and you can, I'll give you a link to set up a new user account.
Okay.
All right. Marcus, how are you doing?
How come I can't mute mine?
You don't,
On the
you don't have your mic set up.
Rebuilding Native Nations pages right here. Yeah, I just had a personal matter that I was attending to at the same time,
Oh,
but I did pull that up to create a username and a password. I'm sorry, I was with some other stuff that
oh, all right.
I would
That's
rather not dealt with right now, but it was kind of, you know.
So have you taken one of these courses before?
No. I think we covered some of it in the intro to casino management class.
Oh, that's right. Yeah, I thought. Yeah, we actually had one of the guys from the University of Arizona up here. So you should have a user account already set up. So it'll just be a question of what your username will be. You might need to have that reset or something.
Okay.
So
is there an option for that?
If you, let's see, what does it give you? Are you returning student? Yeah, so if you click on are you a returning student and it comes up to the login page, they then have a link for forgotten your username or password, and then they prompt you for an email address. So
Okay.
I would do that and maybe put in whatever email address you may have used. I don't know if it was your personal email or your student email, but
I don't know either. Okay.
so try that, and then just let me know if you get hooked up there.
Okay.
See who else. So Jessica, I'm going to put in a request for you also to reset it. How about Drea? I'm going to unmute you, Drea.
Policy, or NNI, at the University of Arizona. The course series explores what is working.
You're already in the course.
Why, as Native
You
Nations,
overachiever.
affairs and create vibrant.
Okay, so which course did it enroll you in? Intro to Native Nations Building or Native-owned enterprises, nation-owned enterprises?
Sandra,
Oh, what? Sorry.
which one are you in?
Which-
No, I was trying to unmute or mute that video, and then I muted you for a while. I didn't hear what you said.
No, I was just saying what course did that put you in when you tried to enroll?
What course did it put me in? I just went to like the first course. It's the Rebuilding Native Nations.
Okay.
And
So-
then there's a video I just like pushed play on it.
Okay, so I'll just need to move you because we're going to be doing another module, but it will start everybody out in the intro if you haven't registered before. So you're good to go. So what I'll do is I will let's see.
Should we open the module?
No, because I don't think you're you're not in the right module. You're in the. I need to have them move you to the nation-owned enterprises module. So, yeah. So let me go ahead and do that. I'll do that tomorrow. Send them an email, and then once I'll CC you in the email, so they can then also reply back to you, and you'll get that. Yeah. So Melissa and Deanna, you probably need to do this obviously from home or from somewhere with a computer. So
What's up with Melissa? Can't see her.
she's on a cell phone. So okay. All right. So,
I was having Wi-Fi problems at home.
oh, okay.
So I'm on my phone, and I'm just gonna listen and put my phone down because I'm driving until I get home. Okay.
Good idea. Yeah. Don't focus on us for a while.
Yeah, somebody forgot to pick the baby up from daycare, so I had to come up here and get the baby. Okay, so I'm on mute.
Okay. All right. So tomorrow I'll send you. You'll all probably get an email. Well, not from me, but you'll be CC'd, and they're usually pretty good about responding. And once I hear back, if they don't send it to you, I will let you know. So, and just to let you know, this module and all of the NNI modules, they have like usually like 40 to 45 different slides, but each slide includes usually a reading, a couple videos, and then they have 4 quizzes in each module. So as you go through these 40 or so, I think there are 43 slides in this one. As you go through the 43 slides throughout the quarter, this is a quarter-long project, you're going to have a quiz about every 10 slides or so. The quizzes are really for your benefit. They're not used in the grading of this class, so it's just sort of a way to test your knowledge of the information. One thing I will let you know is that some of the information from this module will be on one or both of the tests. And so I'd recommend either taking a few notes as you go through, or the other thing you can do, at least for the reading portion of it, or for the slides, because they'll have PowerPoint slides usually for each in each slide also, is you can copy and paste those into a Word document. So, and a lot of this information is really good information that you'll hopefully use in the future. So it's pretty easy just to copy and paste that into a Word document, and then you have it for later in the course. So, but in general, the entire module is probably going to take you 12 to 15 hours total. So we're going to do this throughout the quarter. And so just plan a reasonable amount of time when I give you an assignment to get to the next quiz. Anticipate you're going to be spending, 1.5 to 3 hours probably working on just going through the module. So, and it's good information, Candace. You'll enjoy it. I don't think it'll be too painful. Okay. Any questions about N and I? No questions.
Hey, I'm trying, guys.
All right. Okay, so what we're going to do now is I just want to go through some information out of Chapter 2. And really this quarter, what I try to do for the most part is cover about a chapter a week. And so we usually get to chapters 8 or 9 and maybe do the case study at the end also. So, so this week we're going to aim for doing Chapter 2, which is really a review about different financial markets, different ways that firms raise money, different types of assets. Again, it's just like Chapter 1. It's laying the foundation for some of the things that we're going to do in the next 3 to 4, well, through the rest of the quarter, really. And so it's a lot of general sort of information. We'll talk about the different types of investments, stocks and bonds, and different types of exchanges. And then towards the end of class, we'll do a reading about a very specific type of investment called collateralized debt obligations, which is what put us into the Great Recession of 2008, essentially. So do a quick reading on that. So I'm just going to sort of launch into Chapter 2 and start out by sharing my screen. And if you have a book, you can also look at this in your book. Actually, I want to open this. Let me open this separately here. Oh, there it is. Never mind. All right. So this is from, I think, page 27 in your book. Chapter 2. And essentially what this is, I like to go through this just because it's a good visual example of how money is transferred between savers or investors and businesses or types of securities. And so this goes through 3 very basic classifications of how money moves from savers to investors. And that's really that's how businesses at a certain point have to grow. They have to raise money if they really want to get big and go nationwide or go worldwide. They need to do more than just use the income, if they're an income producing business, hopefully, to expand to new locations. At a certain point, they need to raise money via sale of stock or sale of bonds or significant loans from banks to really expand past a certain point. And so these are 3 of the ways that businesses can essentially raise that money, and a saver or an investor, and that's just a person who has money that they want to invest or save and earn something on that money, how that money gets to those businesses who need it. So I'll go from top to bottom here. Direct transfers is the first one. And this doesn't occur that often in the context of stocks and bonds. It happens more, what you would see here in direct transfers is like a smaller business who gets a big loan from a bank, or maybe gets a big loan from an individual or a venture capital fund. And those savers, which are the venture capital fund or the bank, essentially loan the business the money to grow, to build new outlets, to build a new factory, to whatever. In some cases, the business may do a private stock offering where they may sell part of a business. And I guess just from a point of view of defining these investments, can anybody tell me what a stock is? What do you have when you have a stock? What is that?
Is a stock the same thing as a share?
Yep.
So it's ownership. It's partial ownership in a corporation. Is that right?
Yep. Yes, exactly. So a stock or a share, same thing, a share of stock. You own part of a corporation, part of a business. You could own 1%, you could own 5%, but usually if you buy a stock or 100 shares of stock on the stock exchange, you're going to own a very, very small portion of this business because the business is huge and they have millions of investors. So if you spend, $1,500 on stock, you may own 0.00001% of that business. It's a very small ownership percentage, but you're still an owner. So you get to go to the annual stockholders meeting every year. Even if you have one share of stock, you get to go to the annual stockholders meeting. And you get to vote on the board of directors. You get one vote for every share of stock that you have, typically. And so it's an ownership thing. You own part of the business, and you hope the business is profitable so that your shares of stock will go up and you will earn some money on your investment. A bond, on the other hand, and some businesses sell both stocks and bonds of their businesses, but a bond doesn't provide any ownership to the person who purchases a bond. So if I bought for instance, Goldman Sachs, this investment company, they actually sell their own bonds to raise money, to do whatever. And so you could buy a bond from Goldman Sachs that pays the equivalent of 2.5% interest or whatever it is. You don't own any of that company, but what you do have is you have a piece of paper that says they have to pay you back what you gave them plus the amount of return on the coupon rate on that bond. So if it's a 2.5% bond, then when that bond matures, and what that means is a bond, it's like the business is getting a loan for a set period of time. So there are 1-year bonds, 5-year bonds, 10-year bonds, 30-year bonds, all sorts of different maturity dates. And so when you buy a bond, and you can either buy it directly from, say, Goldman Sachs, or you can buy it on the public stock exchange if it's traded there, you can hold that until the bond matures. And at that point, the business has to, one, pay you back the money that you loaned them in the first place, because that's really what it is, and also pay you the coupon rate, the percent of interest that the bond carries. So one of the big differences between stocks and bonds, just from a risk point of view, is bonds are less risky than stocks in one context. If the business goes bankrupt, the bondholders are creditors of the business. So if the business goes through bankruptcy proceedings, if you hold a bond of that business, you are due some amount of money from whatever assets they have going through bankruptcy. Okay, and you're sort of towards the head of the line, because they have different classes of creditors and individuals or businesses who get paid out depending on how much money the business has when they declare bankruptcy. Stockholders are all the way at the end. So if the business only has enough when they declare bankruptcy to pay off their people who hold the bonds and their suppliers who they owe money to, and anyone else who they have a signed, secured line of credit with, and there's no money left, and usually there's not even enough money to pay off all those people, so they just get paid off a portion of their what they're owed, then the stockholders get nothing. And that's essentially what happened with like Washington Mutual. Any stockholder in Washington Mutual essentially lost all their money when Washington Mutual went bankrupt, because Washington Mutual couldn't even pay off the people who had loaned it money, whether they be suppliers or creditors or bondholders. And so that's one reason why bonds are somewhat less risky than stocks, just in that context. But you'll also, in general, earn less on bonds than you would on a stock, on a well-performing stock. So, and we'll talk about risk and its relationship to return throughout this quarter. But that's one example of sort of, you have one investment that's less risky but also has less of return, and you have another investment, a stock, that maybe has more risk and therefore has a higher level of return. So those are securities. And so when you have a security, and back to number one here, direct transfers, the savers give the business the money, and the business does whatever they're going to do with the money. And in return for that, the savers get either a stock or a bond, depending on what the business is offering at that point. And so that's one way a business can raise money. And that's sort of on a smaller scale, because businesses usually can only manage, maybe to do this with 100 investors maybe. But when they're looking for thousands of investors, then they sort of have to go to method number 2 here, which is indirect transfers through investment bankers. And this is an example of what happened, say, with Facebook. When Facebook went public, for a long time, Mark Zuckerberg owned it privately. And then at one point, it was just getting bigger and bigger, and they needed to raise some money. And so he sold, I think, 49%. He made 49% of the business available via stock. And so he still has a controlling interest in it, as far as I know. And so they sold millions of shares, and I think they sold 49% of the business, and I think they raised like over $20 billion. So the valuation of the business when those shares of stock was sold was estimated at $50 billion. But to do that, they need to be able to sell that number of shares and raise that amount of money. They need some help. And so that's where investment banks come into play. And investment banks are not like your normal banks. It's not U.S. Bank or Whatcom Educational Credit Union or any of these banks. They don't take deposits like depository institutions do. And so, but what they do is they provide services to businesses who want to raise a bunch of money via shares, or by selling shares or stock, or by selling bonds to investors. And so they organize the whole thing. They figure out how much, they try to estimate how much a share would sell for, so that they would be able to sell all the shares. They obviously want to maximize the amount of money that they raise for the business. One, because the business wants as much money as they can get, but two, because the investment bankers are paid by a percentage of how much money is raised through this what's called an initial public offering. If it's the first time a business is sold stock, it's called an IPO, or an initial public offering. And so usually investment bankers earn 1 to 3% of the total amount of funds that are raised. So in the case of Facebook, you can think about, say, 1% of $20 billion is $200 million. That's how much the investment bankers made just in fees from that.
Oh, Steve?
Yes.
Oh, hi. Sorry I'm late. I was just checking in with you, letting you know I'm here.
Okay, thanks.
All right.
So investment banking is a very lucrative business. And so if you're into wanting to make scads of money and don't have many ethics, then investment banking is something you might want to consider. Just kidding. I'm sure there are some ethical investment bankers, but in the last 10 or 15 years, investment bankers have gotten a pretty bad name for being ethical because they have sold some securities that really haven't benefited their client, the business, in the long run. And I'll talk about that, I'm sure, sometime in this course. But I try not to digress into editorializing it right now. So anyway, so the investment bankers, they put together this offering and they pick a date and they say, okay, this is the date we're going to IPO. We're going to sell these shares of stock. And what really happens is that preferred investors and stock brokerages and some of the investment bankers themselves are the first ones who get dibs on these shares, especially if they set it at a price that they think it's going to go up. A lot of them want the first to be able to buy it first. And so they'll usually get first dibs on those shares, and then they'll hit the public market, and that's when supply and demand starts impacting what the price of that stock is going to be, or the bond is going to be. And so then the savers, to be able to purchase these things, they pass money back to the investment banks, who then take their cut, and they pass money back to the business. And so that's the primary method. If you see stocks or companies raising money on, say, the NYSE, the New York Stock Exchange, or the NASDAQ Stock Exchange, and they're big businesses, this method number 2, is the typical method that you would see them raising money with, using investment banks. Okay. And then this third method here is, it's called indirect transfers through a financial intermediary. And really, this is a good example of, say, a mutual fund. A mutual fund is a financial intermediary. And really what that means is Vanguard. Vanguard is a huge mutual fund company. They probably have at least 500 different types, literally types of mutual funds that are just Vanguard funds. And what they do is they set up a fund, and they can focus on a particular sector. So maybe they'll just buy health. This will be a healthcare mutual fund, or maybe this will be a technology mutual fund, or maybe it'll be a mutual fund that tries to mirror the Dow Jones 500 average. And what they will do, the mutual fund, will be to buy securities based on whatever their focus is. So if it's a technology mutual fund, let's use that example, they would buy stocks from, probably Google and Microsoft and whatever they feel are good investments in the technology sector. And then they put them all into this mutual fund, and they calculate what the value of those shares should be based on how much they bought. And then they'll sell those to savers, to people like you and I, who maybe don't have $10,000, $20,000 to invest in one stock. And what that allows you to do as an investor is to diversify your risk. And it specifically allows you to diversify what's called company risk. Because if you have $1,000 to invest, you're probably only going to be able to say, if you're buying direct shares of stock, maybe you'll be able to buy 50 shares of one company's stock. So you have 50 shares of one company, and that's your primary investment. The problem is you have a lot of risk if that company goes down. Your entire investment is in that company. And so if, for example, you were invested in Washington Mutual prior to 2008, you would have lost your entire investment. But if you were invested in a mutual fund that was holding Washington Mutual as one of their investments, and usually mutual funds will hold 50, 100, 200 different securities, different stocks. So if one of those companies goes down, then you're really, on average, only taking a hit of 1/50th or 1/100th of your investment. So maybe 1 or 2% of your investment you would lose if that mutual fund were holding Washington Mutual at that time. And so mutual funds are great for investors who don't have a ton of money, because they allow you to diversify and get away from some of that company risk. And so with $1,000, you can get exposure to 50, 100, 200 different businesses and securities that are picked, hopefully, by mutual fund advisors who are evaluating the market and evaluating these companies every single day. And so the financial intermediary, the best example is this mutual fund. And so they will buy stocks and bonds from businesses, again, in this case, technology stocks and bonds. and they will put it together in a mutual fund, and they will say, okay, the technology mutual fund for Vanguard is selling shares at $9.54 or whatever it is. And then savers like you and I will buy those, and they will give money to the mutual fund, who will then obviously reimburse the business for these securities. They don't get fronted for the securities, by the way. They have to purchase them. And so that's how money gets back to the business in this scenario. And just like shares of a mutual fund operate just like shares of stock, in that supply and demand impacts whether they go up and down and up and down, you know. So these are sort of the three very general ways that to describe how a business would raise money in our capitalistic system. Anybody have any questions about any of those three or anything I just said?
Capital allocation process.
Mm-hmm.
The only question I could think of is that so like in a mutual fund, like you were saying, it's just like a collection of investments of different companies and stocks or bond. It's only stocks, right? Is that correct?
No, it could be stocks or bonds, and in
Okay.
fact, some mutual funds have both stocks and bonds, and some mutual funds just have bonds. If you go to like the Vanguard site or Fidelity site, you can look through literally hundreds of funds, and each of them have a specific focus, and so it just depends on the focus of the fund. Some mutual funds only buy, say, shares of stock from companies in South America. And so there are some international mutual funds like that, or China or wherever. So it just depends. There's all sorts of different focuses in mutual funds.
Okay. And so the other question I had was, because you were talking about if one of the companies took a hit, it would only be like that company within the mutual fund. So if one of the companies were very successful, so that would mean that their stock price would rise, right? So in turn, that would increase the value of your mutual fund.
Yes.
Is that how it works?
Yeah.
So also, if the business was doing very well and the price and stock rise, that would have nothing to do with bonds. Is that correct?
No, because they're two separate securities.
Okay.
If a company, I guess what I'll say is, if a company is selling both stocks and bonds, they have them on the open market, it's very likely that the same information that's going to cause a share of stock in that company to rise would also cause the value of their bonds to rise. Because good news for a company is they're making more profits, or they're very stable, they have a lot of stability looking into the future. They have a lot of growth. Positive news like that is going to impact both the stock and the bond price if they have both of those.
Okay.
Yeah. But they are two separate securities.
Okay. Yeah. Makes sense.
Any other questions? All right.
Good question.
Yeah. Thank you. Let's take our 10-minute break right now before I launch into talking about different types of markets.
Is that the same chapter or a different chapter?
Same chapter, still in chapter 2. Yep.
You might as well just go over some of these answers for next week's assignment.
Really? That's not how I roll.
Come on. 2-1 through 2-4 and 2-8.
Yeah, as I recall, those are some challenging ones.
Okay. Great.
Let's see here. Let's do this.
So like this diagram, is there anything like that on page 27?
Mm-hmm.
That is like that in like, what is it? The Khan Academy video?
Oh, I don't know.
I like
It's been,
Khan Academy.
yeah, it's been a long time since I've been to their site. It wouldn't surprise me if they did have something like that.
So I'm gonna browse around in this one. And that MNI.
Oh, okay.
Does not stand.
Native
Native
Nations
Nations
Institute. Yeah.
Hey, Steve.
Yep.
On that Native Nations course,
Uh-huh.
I'm not able to find any email. Like I put in both of them. I don't know. Is there a way to find, except for my student email, is there a way to find your student email address on your email somewhere?
Well, actually, you know what I do then is I just go ahead and just create a new username using one of the emails.
Yeah.
Yeah. Just create a new account and see if it lets you do that.
Okay. I'll just do that now.
Yeah, and then just let me know.
Okay.
That if that allows you to get in.
Okay.
Types of market.
Are you reading my mind? That's what we're going to cover next.
That's what you mentioned, right?
Yeah.
Financial market.
I thought maybe you found some more of my files or something.
I'm not going to mention it next time I do.
I'll remember I have to be careful with that next time. Another reason why I change things up every quarter, because who knows what I forget to hide. You wouldn't get as much out of the
that mean we
course.
can persuade you?
No. Persuade me to do what?
I don't know. There seems to be so much assignment. 100 points here, 100 points there. Come on, shouldn't there be a limit? 200 a week.
Well, some like the discussion for this next week. That's just like just type.
The discussion's good.
Type me 2 or 3 paragraphs telling me what investment you would choose after reading chapter 2.
300 points next week.
Yeah, I basically try to have like
200.
2 to 3 assignments a week.
Come on, the third one can be a bonus.
You'll get extra credit throughout the opportunities throughout the quarter. Don't worry. All right, I think we've had about 10 minutes. Looks like most people are back. All right, so I'm going to continue on, and we're going to talk about different types of markets and types of financial institutions. So let me share my screen here. I'm going to show you, I'm just going to do this in Word so you have a little visual here of what I'm talking about. So chapter 2, one of the sections classifies different types of asset markets as one type or another. And it's really just a way to think about these different markets. And so I just wanted to briefly go over them so that you were familiar with how these classifications are used. And so I'll start out with physical asset markets versus financial asset markets. So these are 2 different types of markets, or 2 different ways to divide up markets. And really the best way to think about this, a physical asset market is a market that actually sells something that's tangible, something that you can hold. So real estate is a great example of a physical asset market. You're buying a house, you're buying land. Commodity markets, there are markets that sell barrels of oil, bushels of corn, pork bellies, things like that. Chicago Board of Trade in Chicago is the largest commodities market in the world, or at least it was last time I checked. So that's physical asset markets, things that actually are something, you're buying something. Financial asset markets are like stock markets, where you're buying a piece of paper that says If it's a share of stock, it says that you own a part of this business. Or if it's a bond, that this business owes you this much money and they have to pay you this much in interest when they pay you back. So, and that's mainly what we're going to be talking about in this course of financial asset markets. So those are intangible items. They give you the right to something, but you don't necessarily, you can't hold it or you can't touch it like a piece of real estate or a barrel of oil or a car or things like that. So that's one way to sort of describe markets. Another way is either a spot market or a futures markets. And the difference here is time. In the spot market, you're buying something, and most of these are commodity markets. So we'll talk about oil, for instance. You can go to the Chicago Board of Trade, and if you have an account, you can buy a contract for 100 barrels of oil to be delivered tomorrow. That's a spot market. You're buying something right now, essentially. You're making a transaction for right now. The futures market, on the other hand, is a market where you're buying something that gives you the right to do something in the future. And it's usually either to buy something in the future. So maybe you want to you have the right to buy 100 barrels of oil at $40 a barrel 90 days from now. So that's a futures contract. On the other hand, maybe you want the right to sell something in the future at a certain price. And so farmers a lot of times like to buy futures contracts so that they can sort of lock in what they will be able to sell their corn for instance. So they might buy a 6-month future on corn for 1,000 bushels of corn at 39 cents a bushel or whatever it's selling for right now.
Which one are we talking about?
Futures markets.
Okay.
And so, so that's one way that they can sort of hedge their bets or at least reduce their risk. They can lock in a contract to be able to sell their commodity, what they're producing, corn in this case, at a certain price at a certain date in the future. So that's why they're called futures markets. Okay. So there, again, the point of differentiation is time. Spot markets are now, futures markets, surprisingly, are in the future. Okay. We also have money markets and capital markets. So when I'm describing these things, these markets, you're either going to be one or the other, right? It's just splitting. It's describing markets by splitting things up into one or another thing. So in this case, in a money market versus a capital market, it's just a way to describe the length of time that you're trying to raise money for. So if you're raising money, if you're seeking a loan or you're selling a bond that will mature in less than 1 year, then that's a money market. You're looking for funds just for up to a year out. So maybe it's 2 months or 6 months or whatever, 30 days even. It's a short-term fund. Those are called money markets.
Short-term.
Yeah, short-term. And in accounting and in financial statements, you can think of money markets. They're like current assets or current liabilities because they have that distinguishing point of being 1 year. It's either something that you can turn into cash in less than a year for current assets, or if it's a current liability, it's something that you have to pay in the next year. So in a lot of cases, the year marker is a significant way to divide things up. So it's the same in this case. Capital markets are markets in which you're seeking funds for longer than a year. So it would be a bond that sells for any period of time longer than a year, a 5-year bond, 10-year bond, 30-year bond, or a share of stock, because typically shares of stock are thought of as a long-term investment in most cases. And so those are examples of raising money in the capital markets. If you're seeking it for longer than a year, that's a capital market item. If it's less, then it's money market. And this is all described in a section in chapter 2. I can't remember what page it's on, but
29.
29. Thank you. So it's on 29 too for review. We have the primary market and the secondary market. And so this has specifically to do with the stock market, the financial markets. And the primary market is the market where shares of stock or bonds are sold for the first time, like the company goes public in the case of Facebook. And these are also a nice term for these types of sales, or IPOs, or initial public offerings. So the first time that a company offers shares of itself, a part of itself, for sale on the open market, it's called an initial public offering, and that occurs in the primary market.
Okay. That's good to remember.
Yeah. And then once those shares are out and, thousands, millions of investors own them, they can sell and buy them as they want. And so once they're already out on the market, any sales, any buying or selling that occurs on the secondary market. So if you go to the New York Stock Exchange right now and you want to buy some Facebook shares,
secondary?
You're going to be buying them from somebody who already owns them. It's not Facebook, so you're buying them on the secondary market. So the only time you're buying on the primary market is when you're buying either directly from the company who's selling them or through their investment bank, essentially, who's putting together the stock offering.
What was IPO? Initial public offering?
Yes, initial public offering. And then sort of the last way to distinguish markets are, we have private markets and we have public markets. And so private markets are where the buying and selling of assets or goods goes on between two parties, like directly between the parties. So if you buy a house, if you buy a car, you're dealing directly with that person typically, or you're buying it from a dealer, whatever. That's a private market transaction. There isn't a car exchange that's similar to the New York Stock Exchange where thousands of people can look at these cars. I mean, they sort of have these aggregators at websites now that you can look at a bunch of 1,000 people selling cars, but it's not technically a public market. It's not open to everyone. Public markets are essentially, the best example is a stock exchange where any investor can go in there and buy a share of stock, a bond, a futures contract, barrel of oil if you want one sitting around your house, whatever. But anybody can go in there and purchase it, and it's a very standardized transaction. And when these contracts for oil or corn and commodities go on, they have standards that these products have to meet to be able to be sold. So it's not like the buyer has to go and inspect the barrels of oil or inspect the corn to see how good it is. There are set standards. And so that allows it to be a sort of a public market transaction because there's not a lot of checking out. Where in the private market, if you go buy a house, you're going to have it inspected probably, you're going to have it appraised certainly, because this transaction is just between you and the owner of the house. So these are sort of 5 ways that you can look at markets from different perspectives, I guess. Any questions about any of those asset markets? If not, I'm moving on. All right. So the next thing you talk about in Chapter 2 are different types of financial institutions. Basically institutions that deal with money in some form or the other. And again, these are just sort of basic definitions to give you some context for what we're going to be dealing with in the next few weeks of the class. So we've already talked about investment banks. So these are banks like Goldman Sachs, as an example, whose goal is not to get you to give them money to put in a savings account or a checking account, because they don't do that. They're not what we call depository institutions. They're simply there to help raise money for businesses who want to sell shares of stock or bonds, or to come up with new innovative investments that could put our entire economy at risk. That's editorial there, but and so that's what they do. They put together investments for businesses, and then they sell it to the open market. And again, they make their money by charging a percentage fee on the amount of the total sale of securities. And they make a lot of money. So these are much different than your commercial banks like US Bank or Bank of America or etc. These banks are there, they're called depository institutions because they take deposits. And so they will take your money and you can put it into a savings account and access it whenever you need to, or a checking account, or you can put it into a certificate of deposit if you want a slightly higher rate of return, but that also means that your money is locked up for some period of time in a CD. Commercial banks, in addition to taking money, they also loan money. And so they'll make car loans and home loans and sometimes business loans. And the way that commercial banks make their money is that the money that they get from depositors and from the federal government, and I'll talk about how that works in a second, they get at a certain rate of interest, and then they loan it out at a higher rate of interest. So if you're, for instance, putting your money in a bank, in a savings account that's probably earning, if you're lucky right now, 0.5% maybe. 0.5%, it's sitting in there, 0.5%, and the bank can use that to loan out for a car loan or a home loan or whatever. And so they take that money at 0.5%, and then if it's a home loan, let's say they make a loan to someone, they decide to make a loan for 4%. So the difference between 4% and 0.5%, 3.5%, is essentially the profit on that transaction for the bank. And that's how the banks make money. They take in money at a lower rate of interest and they loan it out at a higher rate of interest. That's the primary way they make money. They also charge a lot of fees, especially commercial banks these days. And that's somewhat different than our next type of financial institution, which are credit unions. One that we have around here is Whatcom Educational Credit Union. There are credit unions sort of everywhere. Sometimes they're associated with a region, a location. Sometimes they're associated with a specific business. For instance, if you're down south, you have Boeing Credit Union is one example. And credit unions are different from commercial banks. Oh, sorry. Commercial banks are for-profit businesses, and they are owned by shareholders. So they're like any other business who has gone to the open market to raise money. They're there to make money, and they have sold shares of stock. So investors own them for the purpose of making money. Whereas credit unions are typically nonprofit and they're what's called member-owned. And so they, by their charter, they're run to benefit their members. They're not run to make profit. Certainly they're run to continue, so they can't lose money. They have to sort of remain stable, as most nonprofits should. But they're not there to make a scat of money like US Bank or Bank of America are for their investors. And so my experience with credit unions are your fees are going to be lower. They charge you less for bounce checks. They sometimes have better services. Sometimes they'll charge you less for a home loan or a car loan than you might get at a commercial bank. It all depends on the credit unions. There are many different credit unions and some are better than others. But the main difference between them and commercial banks is that they're not run for profit and they're member owned. They're not owned by shareholders. So if you haven't looked at, considered a credit union, I'd recommend at least checking a few out for just basic checkings and savings account. Because I know up here at least, Whatcom Educational Credit Union, their fees for bounce checks or account transfers or anything like that are so much lower than like US Bank or Bank of America. It's a good value. I try not to bounce checks, but it happens. Okay, so those are credit unions.
How come we skipped? financial services corporations?
Because I'm only covering some of these financial institutions. So yeah, so there are definitely more financial institutions that are listed in your book, but the only ones I really want you to
These are the
be
most
comfortable
common?
with it. Yeah,
Okay.
I want you to know about these ones.
Okay.
So another type of financial institution are insurance companies. So Safeco, Geico, wherever. All these insurance companies that will sell either, they sell life insurance, home insurance, car insurance, liability insurance. For businesses, some of these companies also sell what's called errors and omissions insurance. And for professionals like doctors and lawyers and accountants who have to provide services to a certain standard, making an error can leave them open to being sued for maybe a lot of money. And so if they can get it, sometimes they will take out, or they'll get an errors and omissions policy. And basically what that covers is if they make any unintentional, not illegal errors, so it can't be illegal actions, that the insurance company will provide some coverage for those errors.
Right.
But so the way insurance companies operate is they take your money in the form of a premium, and in exchange for that, they provide some protection from risk. So car insurance, if you get in a car accident, they'll hopefully help you pay for the repairs. Home insurance, if you have damage to your home, they will help take care of that. And so it's really what they're selling is, to some degree, a peace of mind. That you're not going to lose your home or your car. You're not going to face a serious financial hardship if something happens. But they make their money essentially by having mathematicians and accountants, mathematicians, accountants, and actuaries sitting around determining the likelihood that some event is going to happen that they're going to have to pay out for. And they base their premiums on that. So their hope is that they collect premiums and they never have to pay out an insurance claim, right? I mean, that's in an ideal world, that would be how they would do business. But the way they have it set up is they crank thousands, probably millions of different scenarios, these actuaries do, and they determine the likelihood of something happening. And then they base a premium for you off of that. And so if it's health insurance, now they're usually you have to take a health exam. They ask if you smoke, and they have all these other questions. And then they put it into their computer, and they essentially crank out the likelihood that you're going to have a claim in the future. And if so, based on that likelihood, they set your premium that way. So
the only financial institution that's actually a nonprofit is the credit union, right?
Of the ones we're going to cover, yes. Yes. Yeah. All, with the exception of the credit unions, all of these other corporations, financial institutions are for profit. So, yes.
So what do you think? Do you think insurance companies are the ones that own most of the high rises in big cities?
That own them or insure them?
Own them.
Own them? I don't know.
I remember hearing that one time.
Oh, really?
A lot of the, well, maybe the skyscrapers or the like the venues like Safeco and Quest. Quest is the communications.
Right. Yeah. Well, I know that certainly the big insurance companies tend to sponsor, to sponsor these athletic venues and things like that. But yeah, I don't know about ownership. I certainly know they're
just a thought.
Yeah. They are big companies though. So yes, the way insurance companies want to operate is that your premiums that you pay them plus whatever they invest your premiums in is greater than whatever they have to pay out in claims. Then they're profitable. We also have pension funds, and another term for these is guaranteed benefit funds. Right? Guaranteed benefit, yes. Or defined benefit, excuse me, funds. Or defined, guaranteed. Both. And a pension fund is essentially a retirement fund, and you don't see these as, around as much anymore. And it's because many of the big pension funds right now are struggling to meet their obligations to their pensioners. And a pension fund essentially, historically, has been, if you work at a company for 20 or 30 years, they have different vesting periods. If you work for IBM in the 70s and you worked with them for 30 years, they had a pension fund where you were vested, fully vested at a point, and after you retired, they guaranteed a certain payment per month for the rest of your life. And you know, and depending on how much you made and how much some funds took contributions, that impacted how much you could withdraw or how much they would pay you during retirement. And the reason it's called guaranteed or defined benefit is because they guarantee this amount until you die, not for 10 years or 20 years or 25 years. They guarantee it until you pass away. And so the challenge with pension funds then is that as they're developed and as employees are working and the company and the employees are contributing some amount of money to these pension funds, which is then invested and hopefully grows at a rate that will allow them to pay retirees in the future, is the liabilities or the obligations to pay these retirees in the future, especially with the baby boomers retiring right now. And there are a lot of these baby boomers who worked in a period of time where pension funds were much more common than they are now. And so all of a sudden, these pension funds are having a high number of retirees coming into the program, and they're having to starting to pay out a large amount of money every month. And if the investments didn't keep up with this growth in obligations, then the question becomes, well, how are they going to pay the pensioners in the end? And in the Great Recession of 2008, where the stock market tanked for about a year and a half, 2 years, many of these pension funds got hit really hard. And their solvency, whether they could continue on, really came into question, because after their investments took such a big hit, they didn't necessarily have the money forecasting out 2, 5, 10 years, whatever it was, to make payments on these pension funds or to the pensioners. And so typically these days, to reduce their risk, companies will maybe offer contributions to your own personal individual retirement account, your IRA, or a 401k, or a 403b, which is just another type of retirement account.
So those would be examples, like you have those other ones have examples.
Yes, although those were examples more of what I'll just say individual retirement funds.
So that would be up to who they.
So IRA,
right, okay.
401k, and this is less a financial institution and more just to contrast that with like a pension fund.
Right.
And with an individual retirement fund, what's different with those than a pension fund is that you're not guaranteed a certain payment for the rest of your life. You're just guaranteed that that money will be available when you retire, and you can start withdrawing it at that point without penalty. And so companies who offer these individual retirement funds now don't have to worry about the fact that what happens if this retirement account doesn't have enough money in the future for the retiree. It's not the company's problem, it's the individual's issue now. So
right.
Yeah.
That's a good way out of it for them.
Yes, yeah, it is a way for companies to reduce their risk for future obligations, is to not have pension funds, and to, you know, certainly some employers, you know, offer matching contributions for individual retirement funds and things like that, but it's definitely a different deal than having a pension. Okay. So I already talked about mutual funds. Mutual fund companies are another type of financial institution. And again, they just sort of are the they aggregate stocks and bonds, and they purchase a bunch, and then they sell it back to you in the form of a share of mutual fund. And one type of mutual fund I just wanted to mention is called an index fund. Does anybody know what an index fund is? It's a type of mutual fund. No? All right. I'll tell you. So an index fund, or I think the book refers to it as an ETF fund, exchange traded fund. Essentially, it's a mutual fund that attempts to mimic the performance of a particular financial market. So, for instance, an index fund might be the S&P 500, which is a group of 500 large companies on the New York Stock Exchange. And so an index fund wants to try to mimic the returns on those 500 companies. So if you look at the Dow Jones average, there's a Dow Jones index fund. And so what a mutual fund company will do is they will purchase shares of all of those companies on the Dow Jones, and they'll put it in a fund, and then you buy it as a mutual fund. And really, your mutual fund performance should almost exactly mirror what's going on with the Dow Jones average. And it's a way to get total market exposure, essentially. Which is good, which could be good and could be bad. But so
what is it?
Exchange traded funds. And the one benefit with index funds compared to maybe other mutual funds is, so mutual fund companies make their money in a number of ways, but one of them is by charging you an investment fee. And so every year, and they have to list this publicly, but every year they will charge their accounts anywhere from like 0.5 to maybe 2% of your assets. And they will deduct that from whatever the returns are from those securities that your mutual fund is invested in. So the benefit with index funds is they're sort of brainless, really, for the investment advisor. They don't have to do a lot of research because all they're doing is buying securities to mimic a particular index, the Dow Jones or S&P 500 or whatever. And so their fees also tend to be quite a bit lower, or should be lower. And so that is one benefit. If you don't believe that these people who are picking the funds for the mutual fund company really deserve 2% and really know better than the market, then you might be interested in an index fund, because then you pay them less and you get exposure to the entire market, whether it's going up or down or whatever. So, and there is I would say, if any investment advisor or mutual fund person or investment banker tells you that they know what the market's going to do in the next month or 2 months or 12 months, I would not believe them. It's market timing, the ability to time whether the market's going up and down is not even something that professionals can do. So I wouldn't believe them. Anyway, so that's ETF index fund. All right, so those are the types of general financial institutions you should be aware of. Any questions about any of those guys? No? Okay. So the last, before we do we're going to have a brief reading at the end of class. But before we do that, the one other thing I want to cover is just some information on the types of stock markets. And really, this is pretty simple, or at least the way we're breaking it down here, is into physical exchanges or electronic exchanges. And so you have physical stock exchanges where people actually go to these places, like the New York Stock Exchange is a physical stock exchange. NYSE, that's short for New York Stock Exchange. The Chicago Board of Trade, CBOT, is a physical stock exchange. That's where stockbrokers go, and they sell and buy stocks, and they wave things around and they throw pieces of paper around. It gets really messy. So those are physical stock exchanges where people actually congregate in one place to trade stocks or bonds or whatever, or pork bellies. Yes, where they ring the bell. If you're lucky enough, maybe if you get enough notoriety in your life or famous enough, you might get to ring the New York Stock Exchange bell. You know, once Martha Stewart did, so anybody can, I think. So the other type of stock exchanges that are much more common these days are electronic exchanges. I guess we'll call them stock exchanges, like NASDAQ, yes. And really, these exchanges don't exist anywhere physically. They're just a network of computers, of different stock or bond traders' computers that they trade shares electronically. And this is getting more and more common, and there's, I believe, the one in Europe is called like Euronext or something like that.
Who was CBOT?
Chicago Board of Trade. Yeah. Yeah, that's where they trade all the commodities, the pork bellies and the bushels of corn and the barrels of oil and platinum and gold and things like that. But the electronic stock exchanges don't exist anywhere in the physical world. They're just a network of computers that allow different traders to trade stocks and bonds. And it used to be that only smaller businesses would be on the electronic stock exchanges. Once businesses got to be a certain size, they would want to jump up to the New York Stock Exchange. But more and more companies are just staying there. There aren't the benefits there used to be in migrating to the New York Stock Exchange for business, and as far as getting a higher visibility and getting exposure to maybe larger investors. Larger investors are just as much in NASDAQ as they are in NYSE these days. And so I believe Microsoft is still traded on the NASDAQ Stock Exchange. Many big companies are. So these are just the way we're breaking down stock markets right now is just between physical and electronic exchanges. All right. That all good? NEXT, yeah, I believe that's what it's called. That's the electronic exchange over in Europe. Okay. All right. Any questions about any of those items? I'm going to post this list of notes just on Canvas tomorrow under week 3, so I'll make myself a note to do that. Don't have all the definitions there, but you at least have the basics of what we covered. So, all right, so for the last little bit of class, what I want to do is, we've talked about stocks and bonds, but there are all sorts of different types of securities that companies sell. And so if you go to week number 3 in Canvas, and there is a link under resources right under the NNI link that says securitization reading. This is also in your book on page 38. So you can read it in your book or on here. But this is just a one-pager that talks about one type of security that was developed by an investment bank or by investment bankers as a way to amp up or juice up the mortgage market in the United States. And it's part of also what contributed to the big Great Recession of 2008. So what I like to do is just take about 5, 6, 8 minutes, whatever, to read this, and then we'll talk about it real briefly. And this will be the last thing we cover tonight.
I was wondering when we had that. So this guy actually wrote a book, huh?
Which guy?
This guy that's referenced, David Adler.
Oh,
Or was that just a, I
that
think it was
was,
just the article.
yeah. Yeah, that was from Barron's online periodical. All right, so this particular, so what happened with these in this particular reading? What was the issue?
Catastrophic results for our economy, people,
So why was it catastrophic?
because they were loaning money to anyone and everyone for homes that they couldn't afford.
Yeah, there were a lot of factors that played into this, and this is just sort of one side of it, but certainly in the early 2000s, lenders were not as rigorous with verifying income for applicants or verifying other credit histories, maybe.
Yeah.
They did stated income loans, which meant that the person wanting to borrow the money just told them what they made. They didn't have to provide proof. And so there was sort of looseness on the front end of people getting into home loans, which is why some of these loans turned out to be riskier than maybe the investors thought they were. But it was also, they put them into a system where the lenders then essentially sold off all these loans to an investment company, these investment banks, who put $100 million of loans together into a security, essentially into a bond, and then they sold it back out to mutual funds, to other banks, to pension funds, which caused a big problem for the pension funds. And so essentially what they did was they created this artificial security based on these loans, all these home loans that they put together. And they created these three different classes, sometimes class A, B, and C. And just like I was explaining before with creditors, if a company goes bankrupt, there's sort of a line, there's a sequence in which people get paid off, and bondholders are before stockholders. So in this case, these different classes, or they call them tranches, and sort of disgustingly enough, there's a winery in California called Tranche Winery or something like this. So I'm guessing they made a lot of money off of doing this. But these different classes would get paid off at different times, and or not get paid depending on the performance of these home loans that were underlying the security. And so these Class A investors would get paid first, Class B would get paid second, and Class C would get paid third. And so it all works out fine if all these home loans are being paid on time and cash is coming in to make the mortgage payments. But when some of these home loans started to go into default, especially the subprime ones, because there was a lot of high risk applicants that were accepted in, then they started defaulting on their payments, and these investors, all of a sudden there wasn't enough money to go around to pay all the classes. And so all of a sudden these Class C investors all the way at the bottom either didn't get paid or they didn't get paid what they were expecting. And so the value of these bonds dropped tremendously. Yeah. And then the entire market started questioning really how risky these home loans were that were in these CDOs, or collateralized debt obligations, because the rating agencies, and there are a few significant ones, but like Moody's and Standards and Poor's, what their job is to rate companies' stocks and bonds, primarily bonds, and give it a grade based on how risky they believe the company is or the investment is. And so they rated these particular investments much higher than they should have been rated. They didn't look at the underlying home loans. And so people were buying them thinking that they were very secure investments, when in fact they weren't, especially when the economy started going down, and then even more of these loans went into default. Yeah. And so so this is just an example of one of the ways that investment banks put together these securities. And And investment banks loved it because they put together the $100 million security, and then they sold it, and they took their 2%, their $2 million or whatever it was, and then they didn't have anything to do with it after that, because then it was just owned by these pension funds or these other banks or these other investors. So they were able to take their money, and they didn't really care about the consequences of what happened after that. Again, which is why I raised some ethical questions about investment bankers or certain actions they take. And so this is just an example of one of the securities that are artificial in nature. It's not a stock or a bond, but it's based on a bunch of underlying home loans and essentially a cash flow that they expect to come out of that, and some of the issues that it caused. It really caused the credit markets to lock up for a number of years, until the U.S. government got involved and started spending lots of money actually buying these things up to support the credit markets. They bought a lot of these securities up, and they still hold them, actually, which is one of the reasons why interest rates are very low right now, because the U.S. government got involved in creating this government demand for these products.
So what regulations came out of this?
Dodd-Frank was the regulations or the financial legislation that was passed. So
what is that, Dodd-Frank?
It created a few things. It created the Consumer Protection Finance Bureau or something like that, which is supposed to advocate for and look out for the interest of smaller investors and smaller individuals seeking loans. But they also, that particular legislation was supposed to require banks to hold more money, to be more liquid, so that they could cover some of these loan losses in the event that people weren't paying their loans. They had very low capital requirements. Unfortunately, right now, the banking industry, the financial industry, and their lobbyists have put a lot of money into campaigns to get legislators to water this down. And so right now, a lot of the provisions, a lot of the regulations that came out of the 2008 Great Recession are in the process, literally, of being watered down, because lobbyists or companies can spend money on lobbyists, and now they can spend money on elections. Corporations can, post Citizens United. Yeah. And so, anyways, that's a big, long sort of story. But this is just, I think, one good example of the ways that investment bankers can create investments that aren't always good for both the person they're developing them for, which in this case was the banks that were selling them these loans, or the person who's going to be buying the security in the end, which in some cases was the same
this situation affected a lot of things in our economy, not just the housing and the banking, but even at the time when fuel was up to what, $4 a gallon and everything. It was part of the primary factor of the recession.
Yep. Yeah.
We survived it.
Yes, we did. All right. So any other questions about that particular reading, CDOs? We could spend a whole class talking about what happened in the 2008 recession. We might do that sometime. Yeah. Okay. So, so that's all I want to talk about tonight. So for next week, if you look on Canvas, I do have a few assignments. I will be in contact with you by the end of the week once I hear back from NNI and they get you all set up with your in the correct module. If you're having any problems getting...
What are we supposed to do with that one, the quiz?
Yeah, just get to the first quiz. So that module is divided up into 4 parts, and so there are 4 quizzes. So essentially get through the first 10 or 12 slides, and that will get you to the first quiz. There's also a discussion, and this is just a general, based on your readings of Chapter 2, what investment would you choose? So write 2 or 3 paragraphs based on what you know. You can read the description there for next week. And then chapter 2 is questions 2-1 through 2-4. So you also have to do 2-2 and 2-3. And 2-8 for next week. And then read chapter 3. We're going to be covering chapter 3 next week. So, all right.
Are you sure that's all you want us to do?
I could add some more things, Candace. I could add something special for you. How about that?
Jeez.
And
The NNI, the chapter questions, and then that one.
The
what
discussion.
investment?
yes.
Okay.
Yep. All right. If there are no other questions, have a good week. And we'll see you next week. If you have any questions in the meantime, email me. And like I said, I'll be in touch about NNI once I hear back from them.
Yeah.
All right. Whoa. What was?
Somebody. It's probably that
Oh,
Richard guy.
it's a baseball.
Oh, was it?
Yeah.
Wow.
Wow.
The maintenance guy.
We just heard a baseball hit the ceiling of this building, and because we're in a modular building, it was really loud.
Those
So,
guys out there.
yeah. Anyway.
Carolie's cousins.
Have a good night. Have a good week.
See you
Yeah,
guys.
you too.